Balance sheets. All seems fine when they balance, but no one wants to be around them when they don't balance. Hi, I'm Kyle, and welcome to another tutorial from Finmodo. Everyone knows that balance sheets can be, frankly, a pain in the ass when they don't balance. Why? Because you know there's potentially hours ahead of searching through the model, with no guarantees that it will balance. Well, not for you and not anymore. What if I could give you a guarantee that you will find where it doesn't balance? What if I could give you a silver bullet? Well, I'm about to deliver on that. And all it takes is some simple understanding of how things tie together on a balance sheet, which means that the next time you see a balance sheet, you may even feel good, knowing that you've got things covered. In terms of learning objectives, on part 1 of this series, I'm going to recap the purpose of financial statements. Secondly, I'll build up your understanding so that you see the matrix on how financial statements fit together. And in part 2, I'll introduce you to the Scalpel method and show you the method in action. So, how does this fit into the big picture? Well, it's module-specific knowledge. Financial statements, of course. So, a quick background. The balance sheet is made up of 3 big chunks: equity, liabilities, and assets. It keeps track of what the company owns versus what it owes. That's how the assets of the company are financed. So, what is it again that we are balancing? Here is the accounting equation, which is like the equation which governs the universe of accounting. Let's zoom out slightly. This is one of the 3 financial statements. The cash flow waterfall, or cash flow statement, recognizes when cash comes in or goes out the door. The P&L, or income statement, recognizes when assets or liabilities are earned or consumed. And one of the jobs of the balance sheet is to keep track of the timing difference between the 2 of these. For example, we pay $10,000 for a piece of equipment, that is, paid in cash. But it is not used up in that period, so it goes on the balance sheet. Each period, an increment of its economic value is used up, so we depreciate it, P&L, and the balance sheet amount is smaller. How about another example? We earn $500 revenue, that goes to the P&L. We receive $300 cash flow waterfall, and we need to account for the $200 unreceived, so it becomes $200 accounts payable. In both cases, the balance sheet is recognizing the timing between the payment for something and when it is consumed. In other words, what future benefit or obligation is expected to arise. The second piece that you should take away from this is that where you have an item in one statement, there is always one or more associated items in the other statements. And that's what we're trying to balance. The 3-way statements are made up of 10 or so of these interconnected items. So let's examine where the other connections are. Let's look at an easy one to start. Dividends are here on the cash flow waterfall and here on the P&L. We've mentioned fixed assets. In the actual account for that, here you have the cash flow item, here the P&L item, and here the balance sheet item. Where do these items come through in the financial statements? Well, the cash we spend on CapEx is here on the cash flow waterfall. This builds up an asset on the balance sheet. Then we depreciate that asset, P&L, and that depreciation expense reduces the value of the asset. Here, the account for working capital. This is like a mini 3-way statement with cash receipts, cash flow waterfall, revenue, P&L, and trade debtors, balance sheet. Note generally, the way we represent cash receipts on the cash flow waterfall is using revenue and then backing out the net working capital adjustments. Expenses are similar with cash payments, OPEX, and trade creditors. Looking at tax, if you have deferred tax assets or liabilities, it's a bit more complicated. But here, we've simplified things by using tax payable instead of tax expense. Tax paid is a cash item, tax payable sits on the P&L, and tax creditors is the balancing item between them. Lastly, connected are your senior debt, balance sheet, and principal repayments, cash flow waterfall. And then separately, your interest, cash flow waterfall, and interest on the P&L. That should give you a good insight into balance sheets and the interdependencies between the financial statements. By now, you may be starting to see how we can create a method out of this. Wouldn't it make sense to remove the things that we know are connected systematically and check whether it makes a difference to our balance sheet balancing or not? Well, we'll cover this on part 2. If you like this tutorial, check out more tutorials on finmodo.com or make sure that you're signed up to our newsletter to not miss any tips and tricks. Now, over to part 2.